Welcome to Elite Finance Insights, your gateway to the financial secrets of the world's most iconic success stories. Every tip we share is a key to the strategies once reserved for the elite. Ready to unlock your financial potential? Let's dive in. And it's Wednesday again. You know what that means? Today, as always, we have our special weekly update where we break down 3 crucial economic events shaping the US market. We'll reveal the most impactful news of the day and explain how these developments might influence your investments, whether it's in crypto, ETFs, or other market sectors. Stay tuned as we dive into today's market-moving insights. Let's kick things off with the first major story, the latest signals coming from the Federal Reserve. Over the past few days, Fed officials have been under the spotlight, delivering messages that have captured the attention of investors across the nation. In several press briefings and public remarks, there have been clear indications that the central bank is intensely focused on containing inflation and ensuring that it does not derail economic stability. While there isn't one single verbatim statement that sums up their entire message, a recurring sentiment from multiple sources has been that the Fed is fully prepared to adjust its policy stance as circumstances demand. One paraphrase sentiment that has circulated widely is, "We are prepared to adjust our policy stance as needed to ensure that inflation returns to our target over time." This message, although not a direct quote from any one official, reflects the broader consensus among Fed representatives. For you as an investor, the implications of this stance are significant. In the short term, even the mere hint of tighter monetary policy can create nervousness in the markets. Growth stocks, which thrive under conditions of low interest rates, might face downward pressure as investors begin to reprice future earnings under the prospect of higher borrowing costs. The anticipation of rising rates can lead to increased volatility, with equities experiencing sell-offs and bonds offering more attractive yields as market participants demand higher returns for the anticipated risk. Over the longer term, however, the Fed's proactive measures are aimed at preserving economic stability. By keeping inflation in check, the central bank is working to create an environment where sustainable growth is possible, even if that means enduring short-term market jitters. This scenario might encourage investors to rethink their portfolios, perhaps shifting focus towards sectors that are less sensitive to interest rate fluctuations, such as consumer staples or utilities, and even exploring alternative investments that could serve as a hedge against increased volatility. Moving on from the traditional world of monetary policy, our next major story centers on the dynamic and ever-evolving landscape of cryptocurrency regulation. Lately, the cryptocurrency market has been abuzz with activity as US regulators weigh the possibility of introducing new measures aimed at bringing greater clarity and oversight to the digital asset space. High-level discussions among officials at the US Securities and Exchange Commission and other regulatory bodies suggest that tighter controls may be on the horizon. In fact, one senior SEC official was quoted as saying, "We are exploring measures to bring greater clarity and protection to the cryptocurrency market, ensuring that investors can participate in a secure and transparent environment." Although the full details are still emerging and the exact regulatory framework has yet to be finalized, this news has already stirred up significant market activity. In the immediate aftermath of such regulatory hints, the crypto market often reacts with heightened volatility. Investors tend to be cautious when faced with the possibility of stricter rules, and this uncertainty can lead to rapid price swings and a temporary sell-off in digital assets. Companies that operate in the blockchain and crypto technology sectors are not immune to these effects either. Their stock prices may experience fluctuations as market sentiment shifts. Yet, when we take a longer view, there is reason for optimism. Clear and well-defined regulations, once in place, can actually benefit the crypto industry by attracting institutional investors who have been hesitant to enter a market marked by ambiguity. A structured regulatory framework can pave the way for a more mature market, ultimately increasing investor confidence and encouraging broader adoption of digital assets. For anyone holding positions in cryptocurrencies or related equities, this evolving landscape underscores the importance of staying informed about regulatory developments. By keeping a close eye on policy changes and understanding their potential impact, you can better position yourself to adjust your investments as needed, whether that means rebalancing your portfolio or seizing new opportunities as they arise. Now, as we shift our focus to our third key story, let's delve into the latest U.S. labor market and inflation data, which has been sending ripples through the financial markets. This Wednesday, fresh economic data was released that offers a nuanced look at the current state of the U.S. economy. On one hand, the labor market continues to show remarkable strength, with robust job growth and unemployment rates that remain near historic lows. These indicators point to a resilient economy where employers are actively hiring and wage growth is putting upward pressure on incomes. On the other hand, inflation figures have once again come in slightly above what many analysts had anticipated, sparking concerns about the long-term sustainability of current price levels and adding fuel to the debate over monetary policy. So what do these mixed signals mean for the markets? In the short term, the strength in the labor market can bolster consumer confidence, which in turn supports higher levels of spending and benefits the stock market overall. When people feel secure in their jobs, they are more likely to spend money, which drives demand for goods and services and can stimulate further economic activity. However, the persistent nature of inflation complicates this picture. Rising prices can erode purchasing power and prompt the Federal Reserve to consider further tightening of monetary policy, a move that could have adverse effects on high-growth sectors such as technology and consumer discretionary stocks. In addition, the bond market is paying close attention to these developments. Generally speaking, higher inflation leads to rising yields as investors seek greater compensation for the declining purchasing power of future interest payments. This scenario often results in adjustments across both short-term and long-term fixed-income strategies, with investors recalibrating their portfolios in anticipation of a more challenging economic environment. Over the longer term, the interplay between robust job growth and stubbornly high inflation creates a complex backdrop for investment decisions. Companies that possess strong pricing power, those capable of passing on increased costs to consumers without significantly dampening demand, may perform better in such an environment. Conversely, sectors that are particularly sensitive to rising interest rates could face ongoing headwinds, making it crucial for investors to stay nimble and diversified. As we consider the broader market implications, it becomes clear that today's economic landscape is characterized by a delicate balance between optimism and caution. On one side, the resilience of the labor market offers a hopeful signal of sustained economic growth. On the other, the specter of inflation and its potential to force more aggressive monetary policy creates uncertainty that investors must navigate carefully. For many, this means adopting a diversified investment strategy that is responsive to both short-term market movements and longer-term economic trends. Whether you are invested in traditional equities, ETFs, or the rapidly evolving world of cryptocurrencies, understanding these dual dynamics is key to making informed, strategic decisions in an ever-changing market. To recap today's Elite Finance Insights update. First, we examined the Federal Reserve's signals, noting that Fed officials have made it clear they are prepared to tighten monetary policy if inflation continues to run high. This approach, while potentially unsettling for growth stocks and other interest-sensitive assets in the short term, is ultimately aimed at preserving long-term economic stability. Next, we turned our attention to the cryptocurrency market, where emerging regulatory discussions in Washington suggest that tighter oversight might soon be implemented. Although this news has already led to some volatility, the promise of clearer rules could ultimately benefit the industry by attracting more institutional investment and fostering a more secure trading environment. Finally, we analyzed the latest U.S. labor market and inflation data. The strong job numbers combined with slightly elevated inflation paint a picture of an economy that is growing robustly, yet faces significant challenges from rising prices. This mix of factors underscores the importance of remaining agile in one's investment strategy, with an eye toward both immediate market reactions and longer-term trends. Each of these developments serves as a reminder that the financial world is in constant motion. The interplay between monetary policy, regulatory changes, and key economic data points creates a complex and dynamic environment where the only constant is change. For investors, staying well-informed and adaptable is not just a good idea, it's essential for long-term success. Whether you're rebalancing your portfolio in response to Fed signals, monitoring regulatory news that could reshape the crypto landscape, or analyzing labor market and inflation data to guide your sector bets, the ability to quickly process and respond to new information can be a powerful tool in your investment arsenal. Thank you for joining us for this week's update. Remember, the key to unlocking your financial potential lies in staying ahead of the trends and continuously educating yourself about the forces shaping the markets. If you found today's analysis valuable, please like, subscribe, and hit that notification bell to ensure you never miss an update from Elite Finance Insights. Until next Wednesday, keep a close eye on the markets, stay curious, and as always, invest wisely.